Jake buys a rental property. Marcus invests the same amount into index funds. Both believe they made the smarter decision. Both are wrong because one forgot to count the hours, and the other forgot to count the zeros. And when you actually run the numbers over 20 years, the difference leaves a pit in your stomach. Let's be fair. Jake and Marcus both have $50,000 saved. Both earn $55,000 a year. They're the same age, live in the same city, and start from the exact same financial position. The only difference is what they do with that $50,000. Jake uses it as a 20-year down payment on a $250,000 rental property. A modest 3-bedroom house in a decent neighborhood. He gets a 30-year mortgage at 70% interest. His monthly mortgage payment is about $130. He finds a tenant willing to pay $130 a month in rent. On paper, that's a $470 monthly profit before spending a single dollar on anything else. Jake feels like a genius. Marcus takes the same $50,000 and puts it into a total stock market index fund. No leverage, no tenants, no keys to hand over. He sets up an automatic contribution of $300 a month and forgets about it. His coworkers ask what he invests in. He says, index funds. They nod politely and change the subject. Nobody is impressed. On day one, Jake has a house, a tenant, and a story to tell at dinner parties. Marcus has a brokerage account and a confirmation email. The feeling is incomparable. But feelings and math are two very different things. For the first few years, Jake lives the landlord dream. Rent checks hit his account on the first of every month. He drives past the property on the way to work and thinks, it's mine. He deducts mortgage interest and depreciation on his taxes, saving a couple $1,000s each year. He builds equity with every mortgage payment. He watches similar homes in the neighborhood rise in value. Everything about the investment feels real, tangible, and smart. Marcus logs into his brokerage account once every quarter, sees the number go up a little, then down a little, then up a little more. In the first year, his $50,000 grows to around $55,000. Second year, maybe $61,000. It doesn't feel like anything is happening. He has no keys in his pocket, no tenant texting him, nothing he can point at through a car window. Just a number on a screen. Jake's friends ask about the property. Marcus's friends ask him nothing. The social validation alone makes Jake feel like he's winning by a landslide. Let's run the numbers to year 3. Jake has collected roughly $64,800 in rent. His mortgage payments total around $47,880. That leaves a gross cash flow of $16,920. Sounds great until you subtract everything else. Property taxes run about $3,000 a year. Insurance adds another $1,500. He already replaced a water heater for $1,200, fixed a roof leak for $2,800, and dealt with a 1-month vacancy between tenants that cost him $1,800 in lost rent plus $600 to clean and relist the property. Property management? Jake manages it himself to save money, but that means late-night phone calls, weekend visits, and coordinating repairs during lunch breaks. After all the real expenses, Jake's actual net cash flow over 3 years lands somewhere around $2,000 to $4,000. Not the $16,920 that looks so attractive on a napkin, and that doesn't include a single hour of his time. Meanwhile, Marcus invested $50,000 plus $10,800 in monthly contributions. With an average annual return of around 10 NAPE, his portfolio sits near $76,000. He spent 0 hours managing it, no calls, no emergencies, but Jake still has advantages. His $250,000 property appreciated at around 3-4 EBI annually, and is now worth somewhere between $270,000 and $280,000. His equity, the difference between the home's value and what he owes, has grown to around $55, is $65,000. That's real wealth, and it came partly from using the bank's money. That's the power of leverage, and it's the one advantage stock investors can't easily replicate. The rent check is the number everyone talks about. It's the number in the YouTube thumbnail, the number at the real estate meetup, the number your landlord friend brags about at the barbecue. What nobody talks about is everything that comes out of that rent check before you actually keep anything. Vacancies. The average rental property sits empty about 1 month per year. That's not a catastrophe, but it means paying the full mortgage with no income covering it. And when a tenant moves out, you pay for cleaning, Small repairs, listing costs, and your own time screening and showing the property. Maintenance and repairs. The rule of thumb is to budget 1-2% of the property's value every year for maintenance. On a $250,000 house, that's $2,500 annually. Some years it's a $7,000 HVAC replacement you never saw coming and can't delay because it's August and the tenant threatens to leave. Capital expenditures. Roofs last 20-25 years. Furnaces last 15-20 years. Water heaters last 10-12 years. These are guaranteed future costs, and they arrive in chunks of $5,000, $15,000. If you're not setting money aside every month for this, you're not running a business. You're gambling on luck. Property management. If Jake hires a manager, he loses $8 to $10 away of monthly rent immediately. Roughly $150, $180 a month. If he manages it himself, he's working a part-time job for free. Either way, it costs something. And then there's the risk nobody wants to talk about. Bad tenants. A tenant who stops paying and understands the eviction process can cost you 3 to 6 months of lost rent plus legal fees. That one event can erase an entire year of profits or more. None of this shows up in the simple $470 monthly cash flow number, but over time it becomes impossible to ignore. By year 5, Jake is deep into the reality of landlording. He's on his 3rd tenant already. He replaced the roof for $8,500, dealt with a plumbing emergency that cost $1,400, and had another 1-month vacancy between renters. He raised rent to $1,950, which helps, but property taxes and insurance rose too. His true return on invested capital, meaning the money he actually keeps compared to what he invested, lands around 3.5 ECACA. After all real expenses. Not bad, but nowhere near the 15-20 EUR return he told his friends about at the barbecue. Marcus still does absolutely nothing. His portfolio grew from $50,000 to around $135,000, $150,000 by year 7, including his $300 monthly contributions. He didn't pick stocks. He didn't predict markets. He did nothing except leave it alone. Compound growth is starting to accelerate. The gains on his gains are now creating more new wealth every year than his original contributions. This is what's happening behind the scenes. Jake's wealth is growing, but slowly after expenses, and it requires constant attention. Marcus's wealth grows in a curve. Slowly at first, then faster and faster. Compound interest is boring during the first 5 years, and astonishing during the next 15. By year 10, Jake's property is worth around $335,000, $350. 1. His remaining mortgage balance is about $166,000. That puts his equity somewhere near $170,000, $184,000. After more than 10 years, and after subtracting all real costs, mortgage interest, taxes, insurance, repairs, vacancies, capital expenses, Jake's total out-of-pocket spending beyond the down payment sits somewhere between $20,000 and $35,000. Marcus's portfolio, with steady $300 monthly contributions and roughly 10 per average annual returns, sits around $165,000, $180,000. He contributed $50,000 up front, plus $36,000 in monthly contributions. Total, $86,000. The rest is pure compound growth, and he never spent a single weekend fixing anything. At year 10, their net worths are surprisingly similar. Jake may even be slightly ahead because of leverage. But here's the catch. Jake also spent hundreds of hours managing the property, took on hundreds of thousands of dollars in debt, and concentrated his entire investment into one asset in one zip code. Marcus diversified across thousands of companies and never lost sleep. This is where the story completely changes. After 20 years, Jake's property is worth somewhere around $450,000, $500,000. His mortgage is basically paid off or close to it. His equity sits around $400,000, $500,000. Depending on appreciation, he's collected rent the entire time. But after 20 years of maintenance, repairs, tenant turnover, taxes, insurance, and at least one major renovation, his total net cash flow profit might only be $40,000, $80,000 above what he spent. Maybe more in a booming market, maybe less in a stagnant one. Marcus, with a 10 EWA average annual return and $300 monthly contributions, has grown his portfolio from the original $50,000 to around $420,000, $460,000. That's with total contributions of $122,000 over 20 years. The other $300,000 plus came from compound growth. No debt, no tenants, no 2 a.m. phone calls about burst pipes. If you compare net worths, they end up in a remarkably similar range, roughly $400,000, $500,000 each. But the path they took to get there was completely different. Jake worked for it. Marcus waited for it. Jake dealt with stress, concentration risk, and illiquidity. Marcus dealt with volatility, but had liquidity and freedom. His monthly contribution by another $200, bringing it to $500 a month. His 20-year portfolio jumps to around $550,000, $600,000. That's because in the stock market, increasing your contribution creates a multiplier effect through compound growth. In real estate, increasing your investment usually means buying another property, taking on another mortgage, and doubling your workload. If I only showed you the downsides of real estate investing, I'd be doing the same thing every stock market influencer does. Stocks carry real risks people prefer to ignore. Volatility is brutal. In 2008, the market fell around 37A. In March 2020, it fell 34A away in a single month. If Marcus had $150,000 invested and watched it drop to $95,000 within weeks, that's not just a number on a screen. That's emotionally devastating. And the data is clear. Most retail investors panic sell during crashes and buy back after recoveries, locking in losses at the worst possible time. There's also no cash flow. Unlike a rental property, index funds don't send you a meaningful monthly check you can spend. Yes, there are dividends, but a total market fund only yields around 1.5 to 2 year. On $150,000, that's roughly $200 a month. Not life-changing income. No leverage. Marcus used $50,000 to control $50,000 in assets. Jake used $50,000 to control $250,000 worth of real estate. That 5-to-1 leverage becomes extremely powerful when home prices rise. And it's one of the main reasons real estate has created so many millionaires. There's also no depreciation tax advantage in stocks. Real estate investors can deduct the theoretical decline in their building's value from taxable income, even while the property itself appreciates. It's a legal tax shelter stock investors simply don't have access to. Real estate investing works exceptionally well under specific conditions. If you buy in a market with a strong rent-to-price ratio, where monthly rent equals at least 0.811 UP of the purchase price, cash flow becomes favorable from day one. If you treat it like a business instead of a hobby, carefully screening tenants, budgeting capital expenditures and building systems, returns can outperform stocks, especially with leverage. If you use strategies like house hacking, living in one part of a property while renting the rest, you can reduce your own housing costs close to zero while building equity at the same time. The stock market simply cannot do that. And if you understand 1031 exchanges, which allow investors to defer capital gains taxes by reinvesting into another property, you can scale a real estate portfolio in ways stock investors cannot easily replicate outside retirement accounts. Real estate is not a bad investment. It's a misunderstood investment. Both Jake and Marcus walked away believing they chose the right path. Jake believed real estate was the proven road to wealth. Marcus believed the stock market would quietly solve everything for him. Neither one sat down and calculated the true cost in dollars, time, stress, and risk over 10 or 20 years. The real trap isn't real estate or stocks. The real trap is choosing either one because of a YouTube headline, a podcast clip, or something your uncle said at Thanksgiving without fully analyzing your own situation. And if you're wondering what happens when you do both, when you own property and invest in the market at the same time, that's an entirely different conversation, and the math might change everything you think you know. But for now, the next time someone tells you real estate always wins or stocks always win, ask them one question. Did you include everything? Because the answer that includes everything is the only answer that matters. In the end, the smartest investors aren't the ones arguing about real estate versus stocks. They're the ones who understand the full picture, the time, the stress, the risk, the freedom, and the long-term math behind every decision. Because wealth is not just about how much money you make. It's about how much control your money gives you over your life.